Hi, it's Matt Sammut. I'm here today from Fortrus Financial. I'm going to talk to you about a couple interesting things. Number one, the financial industry. They're famous at spinning stories, and I'm going to go through you examples of exactly what they do and how they fool the majority. But more importantly, even, I'm going to talk to you about why they will never absolutely pull you out of investments and protect you when things get tough. First, let's have a look at spins. Spins is basically saying, let's turn a negative story into something good, and the industry has to do that. They got to keep you invested. So let's look at an example of GDP. That's the growth of an economy. All of a sudden, the GDP comes out, and it's really strong. So in theory, what that means is interest rates are probably going to be pressured up. It's not necessarily good for the markets, but here's what they're going to say. GDP's up. Oh my gosh, we are so lucky. Our investors are now going to make even more money because corporate profits got to rise in such an environment. Buy, buy, buy. Now let's look at the other side of the coin. GDP goes down, a lot weaker than expected. What does the industry say? Wow, weak GDP, economy shrinking. This is great. That means the Federal Reserve and Bank of Canada and other central banks are going to jump in there, keep pumping money into the system, lower interest rates, and that's going to drive the markets even higher. So isn't it interesting? Two sides of the coin, same result. What's the real story in that case? The real story probably should be not necessarily based on the GDP. That's a story that's spun. There's so many factors that impact markets. Generally, in today's environment, rising GDP isn't necessarily good because that could push interest rates up. The last thing we can have. There's a reason things are at zero interest rate and in some cases negative interest rates. Things are not good. Let's look at a second example, interest rates. So I hinted at them there, but interest rates. Interest rates are rising. Uh-oh, not good necessarily. But the industry is going to say if interest rates are rising, wow, that's a sign that the economy is turning. Corporate profits are going to start to rise. What does that mean? Stock markets rise. Get in. Buy, buy, buy. The opposite side, interest rates are falling. Wow, how lucky can our investors be? The banks, the central banks are bringing interest rates down again. What that simply means is it's going to push up risk markets, equities. They're all going to rise in such an environment because that's what they do. Falling interest rates pushes these things up. Interesting. Again, two sides of the coin, same result. What about employment? Same thing. I could go on and on. Employment. Rising unemployment. Uh-oh, not good for the environment. Not good for Main Street. But what they're going to say is, wow, not good on the surface, but boy, is that going to help our investors because with unemployment going up, there's going to be no pressure on interest rates to rise to try and cool off the economy. That means that markets are going to continue on this path upwards. And falling employment, well, boy, falling employment, again, we're going to get those central banks in there pumping money and keeping things afloat. Good, good, good. What about market action itself? If markets are rising consistently, what do they say? We actually say that rising markets are good to a certain point. Overextended markets are dangerous and definitely at the risk of correction and even in today's world a collapse and potentially a big collapse. But if they're rising, the spin by the industry is simple. Rising markets, don't be left on the sidelines. Get in there and buy more and keep buying. This thing's not going to stop going up. Falling markets, down 10%. Wow, what an opportunity to buy at cheaper prices than they were a few months ago. Down 10%. Let's get in there and buy, buy, buy. Down 20%. A little painful, isn't it, customers? We're sorry we went through it. We sort of missed that. But at 20%, my gosh, the story's even better today. We got to buy up like crazy. The only time you may get a little bit of the truth, market's down 50%. The truth is they're going to hide from you. They're not going to want to take your phone call. They're going to tell their assistant, I'm not here. And if they do take it, they're going to say, sorry, what can I do? I couldn't read the markets. Yeah, that's why you're paid, in some cases, 7 figures, not to be able to read the market. If you're a salesman making 7 figures, I struggle. If you're a great money manager making people money, making 7 figures, you earned it. The majority of people, by far, don't earn it. Now let's talk about the really important aspect that this leads to. Why the bank and brokerages never sell you out. A lot of them say, well, how are we supposed to know? We have unbelievable tools that will tell you, not right at peak. If you sell right at peak, you're lucky. But if you sell near peak, you're a prudent money manager who knows what you're doing and knows the tools to use to do it. What they're going to do is always want to keep you in. Why? Simple. There's a number of reasons. In Canada, and in the US for that matter, the investment banks have an investment banking division. They make monster fees at raising money for corporations. What is the research department of those firms going to do? Rate them as sells and then get a deal? Not a chance. They're always going to have to rate them as buys, probably not even a hold. If they're rated as a hold, they're going to quickly change it to buy if they sense a deal's coming, because they're going to make hundreds of thousands of dollars, in case multi-millions actually. I want to say hundreds of thousands, multi-millions of dollars on these deals. So that is one thing. Number two, what are corporations about, especially in the banking financial industry? One thing, profitability. They want to make more money quarter after quarter after quarter. You may say, geez, that's a flaw of the whole corporate system. We agree. And we'll do another video on specifically a system we think that would be so much better way of analyzing companies. But let's look at it today. They're famous at wanting profits. And you know why? How's an executive paid? How's a senior management paid? They're paid primarily based on huge bonuses, based on year-end profitability, and they're paid a monster amount in stock options if that stock performs. How do you get a stock to perform? You need profits. Where do you get the profits? Off of your back. And that's what's awful. When things are ugly, they're not going to reverse course and say, get our customers out, protect them. It won't happen. Put yourself even in the shoes of an advisor who's managing your monies. They may have 100 million, 200 million or more that they manage under administration. Let's say it's $100 million. They get 1% average fee. Charge a lot more, but let's say 1%. It's $1 million in fees. They get half of that, $500,000. What's going to happen if all of a sudden they say things are going to collapse, I got to get everyone out and move them into cash or in very conservative bonds? Their fees should decrease by 75 to 85, 90%. So their income goes from 500,000 to 50,000. Their lifestyle, they're living the life of a 500,000, probably 700,000 in today's world. Unbelievable leverage. They want a high flying, best cars, best homes, best toys. It won't happen. What they do is keep their fingers crossed. It doesn't mean they're necessarily bad people. The good ones actually don't sleep at night. The bad ones are only thinking, how can I get more money from my clients as they're all calling in wanting to sell? Can't have that happen. And there's a lot of them in the industry. Bottom line is, you have to be self-empowered. That's what we do at Fortrus. We help our customers, educate them on fee management, educate them on market timing, educate them on putting strategic investment plans together, educate them on risk management strategy. You have to do this. And our platform has shown to blow away indexes, let alone the average money manager who always, or not always, but 80 to 90% underperforms indexes. Come on over, have a look at Fortrus. We offer a free Fortrus 4-minute where we provide some a good free e-newsletter, but we have some great platforms if you're serious about things. We want to bring you on as a coaching customer. Thanks very much. Be a winner in this game.